Hi guys, welcome back to our next class of accounting. Before we had talked about what accounting was, that accounting was the language of business, and we talked about the purpose of providing information for the different users. Well, now today we're going to talk about the typical accounting activities and the role accountants play in identifying, recording, and reporting the financial activities of different types of organizations. Now, the different types of organizations, there's mainly three. The first one is a for-profit business, the second is a governmental entity, and the third is the not-for-profit entity. Now, a for-profit business is what it says it is. The primary purpose is to earn a profit by selling either goods or services. Now, goods are tangible things like, for example, a loaf of bread. And then services is like a grass mowing company. So the three different types of for-profit businesses that we're going to be talking about are manufacturing, where they use raw materials and then they create a final product. And that final product is either sold to another manufacturer or it's sold directly to an end consumer. The next one is a retail, and they buy goods from the manufacturer and then they sell them to other businesses or consumers. And then the third one is a service. They don't sell tangible products to customers at all, but they provide a service. For example, accounting is a service. If you see a CPA firm, they are providing a service. A car repair service, anything like that, they're providing a service. Landscaping, that's a service. They don't provide goods, but they provide a service to customers. The next one is a governmental entity, and they provide services to the general public, and they are at the state, federal, and local levels. They are funded through taxes, other fees. The school is a good example of a governmental entity, and it is funded by the taxpayers. So, and then the last one that we're going to talk about is a not-for-profit entity. The primary purpose or mission is to serve a particular interest or need in the community. A not-for-profit is what it says. It's not in it to make money, but it is to have a mission to serve a need in the community. And it relies on donations and grants for its money. So let's look at the automobile industry. That can represent all three parts of the different companies. It can represent manufacturing, retail, and service. An automobile manufacturing plant could represent the manufacturing. A car sales lot would represent the retail, and a taxi could represent the service industry, or something like Uber or Lyft. So that is an example of how one product can fit all three organization models. Now let's talk about why accounting is important to business stakeholders. And let's talk about what a stakeholder is. A stakeholder is a person who relies on the financial information provided by the business in order to make decisions. Examples of the stakeholders are stockholders, and they own stock in a business. If a business is publicly traded, they trade money for an ownership interest or a stock in the business. So they have money in the business and they're concerned with the success. And also they know if the company does well, their stock value will increase and the ownership value will increase. Also, creditors and lenders. These are the people who give money or products to the business with the promise of being repaid at a later time. So they use the accounting information to assess the risk of their not being repaid. Rarely do businesses pay for goods and services that they get at the time the goods and services are delivered. So they extend credit and to be repaid at a later date. So the creditors and lenders depend on this information to make sure that they're going to be repaid. Also, companies borrow money from banks when they need to finance certain projects, certain parts of their operations, and they pay this money back over time with interest. So they need a dependable information, a dependable financial statement in order to provide to the banks and lending institutions in order to get the funds that they will need to operate. And more examples of stakeholders are the governmental and regulatory agencies such as the SEC. They're responsible for overlooking the accounting profession to make sure that they're following the generally accepted accounting principles. So they are putting reliance on the financial statements because they have been prepared in accordance with the generally accepted accounting principles, or GAAP. Customers are another stakeholder, the ones who purchase products and services for a business. For example, if you were another business who depended on a warehouse to provide your materials, or a manufacturer, you want to make sure that they're going to be in business so you can provide it for your customers. For example, Nabisco selling products to grocery stores. That is one example of customers. Then you have an end user customer, such as a shopper in a grocery store. And finally, you have managers and other employees who put trust in the financial information of a business. Employees have a strong interest in the financial performance because they want to know that they're going to be getting a paycheck. They want to know that their jobs are secure, that they've got a future with the company, and they don't want to have to worry about the company that is going to not be there in the future for them. Also, managers and others in the organization have the responsibility to make the day-to-day and long-term decisions for the organization. Remember, we talked about managerial accounting. These are the users of that type of information, and they're going to be making the decisions. So they have to know that that information is provided soundly, and they can depend on this information in order to make an informed decision.